Nathan Cox of TwoPrime. He is the co-founder of the hedge fund TwoPrime. Nate, how's it going?
Oh, it's great, man. It's really great to be here. Thanks so much for having me. I'm really excited to talk to you. And yeah, it's been it's obviously a wild time in crypto, so it's great to connect.
Absolutely. Yeah, we've talked for a long time, but this is the first time actually connecting face to face, at least virtually. So really excited about that. So Nate,
Yeah,
I was thinking maybe we could start with a little bit of your background and your previous career before starting TwoPrime and how you got into trading.
sure. Yeah, it's been a long and a strange road. I got into derivatives trading when I was really young. It was sort of a happenstance. My parents got me into it when I was like 16 and 17. They went to this derivative options trading class, and it didn't stick for them, but it stuck for me. So I went on and through college was sort of trading in personal accounts and got a degree in economics, and then ultimately went on and traded on a derivative desk for a medium-sized family office in Phoenix, and we did lots of like binary events. So I kind of got a taste of what it was like to trade volatility, and it's I think like any vol trader, you go through all these sort of phases of like I want to be a long vol trader, then I want to be a short vol trader. Maybe it's best to be a combination of both. So going through really sitting on the professional derivative desk, I really kind of cut my teeth as a vol trader and got a real sense of when the right time was to be both long and short vol. And then from that, ultimately spun out and started my own fund with two other partners and managed that for 6 years. Called Prana Capital, also out of Phoenix. And we went from doing binary events on all kinds of equity derivatives to getting very narrowly focused on the vol space as an asset class. So we went into the VIX and VIX derivatives, so all the ETPs and ETNs on the VIX, so VXX and UVXY, and traded through the SVXY collapse, which was wild and crazy. And we did all kinds of, like calendar vol trades where we'd be long and short VXX and UVXY and these different pairs trades. And it was great, and ultimately watched some of that industry really start to develop, and also watch some of the margins start to, I won't say collapse, but certainly get compressed. So I made an exit, which was great for me. Went and did the traveling thing for a couple of years, and then got roped back in because crypto was the hot thing. And one of the guys that I'd worked with in at Prana Capital called me up and was like, "Hey, we're launching a crypto fund, and I think it'd be great to help us launch it." And so we founded TwoPrime, and have since grown the fund to about 200 million in assets. And we focus specifically on the derivative side, so hopefully bringing a little bit more of a niche approach to managing crypto, not just necessarily long spot, but using that spot as collateral to then trade the volatility space and generate yield and generate alpha for investors.
That's awesome. That's fascinating. So
Yeah,
I'd love to dig a little bit into some of these strategies because obviously
yeah,
what we're doing now in crypto or what you're doing in the crypto derivative space is fascinating. We'll probably end there, but before that, the
yeah,
VIX ETPs are also like a very sophisticated product with a lot of insights. And before that, you did the family office and you kind of did binary kind of
yeah.
trade ideas. So is that something like earnings are coming out, they're implying this type of movement, so I'm either going to sell a call spread or buy a call spread and play this earnings event? Is that kind of the
Yeah,
idea?
yeah, exactly. So we would do everything. Earnings were a huge part of what we did, and we would usually do. It was kind of a strategy where we would look at the implied vols across the board, find the best implied vols with the best liquidity, and then we'd go in usually short, a bunch of different strangles. We'd probably hit on 80% of those. We look at the implied move on the binary event. We manage the ones that didn't work, or we just immediately close them. But if for anybody that's in the ball space, you're playing the math on these things, and you look for different concentration risk and that kind of stuff. But it was great strategy, and I think the challenge in that was it's kind of like having a lot of plates spinning all at once. So you're certainly, if you're trying to hedge these things, it becomes difficult because you're in literally every sector of the market if you're trading the S&P 500. But it was a great learning experience for me because that was where I learned a lot about, when is it ideal to be long and short vol. We did a lot of, statistical analysis on how to rank volatility and applied vols and all these things. So it was really a huge, sort of learning experience for me. And then from that, we said, why don't we take everything we've learned about trading 500 different equities and then take it into something very specific that is literally trading vol and then vol. But yeah, it was, that was the beginning of my really deep dive into the volatility space.
That's fantastic. And did you have
Yeah.
I guess, did you have like a mentor there at the family office where did you start as a junior and work under a senior and then finally?
Yeah, definitely. So we had, there was probably 6 traders on the desk. Sort of the head of the family office was a longtime derivative trader named Brent Robertson. And he, managed probably the largest pool of the assets, but they had around 150 million under management. And, before that, I was very focused on like technical analysis and looking at fundamentals and these companies are going to beat and all this stuff and trying to predict price movement. And I think the thing that really flipped for me, like the switch really flipped on, was like predicting price movement is such a arbitrary game to try and play. Sort of like there's this, it's the witch's cauldron of trying to put all the things in and then say, I know the direction. And you think that you're smart if it goes the way you thought it would, and you feel immediately stupid if it doesn't. But then predicting vol is a much more, sort of concrete science in the sense that it's a mean reverting asset class. There's limits to basically what the highs and lows can be. It tends to operate in some sort of range. It doesn't mean that it can go outside of that, but you can do a lot better data analytics on it, and we can look at the probabilities of mean reversion, and then you can get paid for that vol. So it's a much more mathematical bet versus, trying to read the tea leaves and say like, Priceline or Booking.com or whatever is, that's good. They're going to beat. Travel's doing, that was like that's the way I think everybody starts, is they do that fundamental analysis. And at least for me, not to take away from that, it became a much more enjoyable experience to try and think about when things are mispriced in the vol markets versus, under or overvalued in a fundamental analysis.
Yeah, that makes a lot of sense. And I think it's one of those games where it's like there's such a necessary knowledge that you have that it creates a little bit
Yeah,
of a buffer around people kind of
yeah,
taking your strategy
yeah.
so easily.
There's a little bit more of a moat. I mean, it's funny because if you talk to folks in the derivative space, it's like you're speaking a foreign language to most, I'll say, equity or traditional asset managers, because you speak Greeks, obviously.
Hmm.
And there's a pretty steep learning curve. I know, because not only I've gone through it, but I've tried to teach other people and bring them up as a mentor. And there's no quick switch that flips when you tell them that you're selling an out of the money call, and the thing that you're collecting is the extrinsic value of that premium that is based on the volatility of the underlying. And they're like, what the heck are you talking about? So there's a lot of learning that has to happen, and there's a natural moat there. But I think also when you find out, once you're in that game, you're also trading with or against some of the smartest people in the room. So it's by no means an easy game, or it doesn't mean it's any easier. You just trading a different asset class.
Yeah, that makes a lot of sense. And then to complicate things a little bit more, like there's these VIX there's the VIX, and then there's instruments traded against the VIX, and then there's an asset
Right.
class of VIX ETPs. Maybe we could just jump into that, and can you give a brief overview of like what was your catalyst for the transition to this product?
Yeah, sure. So I mean, I think the biggest thing for me as I started to develop a better sense of what really worked in the space was focusing more and more on volatility as an asset, as a pure asset class, versus as part of say an equity asset that had these same sort of exogenous risks where, if we would play a binary event like earnings or an FOMC event, you're still bringing in a lot of exogenous variables that you can't control and can't predict. You can beat, you can surprise and you can go outside of these, whatever you want to call them, these mathematical boundaries or predictions. And what you end up doing is trying to hedge a lot of positions, and you have too many sort of plate spinning or whatever, versus transitioning into the VIX, VXX, UVXY. For us was much more of a pure play where you're really trading index volatility, which tends to be a much, I'll say, smoother asset class. It's the difference between trying to trade vol on Tesla versus vol on the S&P. Obviously, Tesla has very high vol, but the reasons are China manufacturing, the price of lithium batteries, whether or not they complete a gigafactory, the list goes on of all these things that are not predictable versus the S&P. Granted, it can obviously move in non-predictable patterns. It tends to be a little bit smoother curve, and therefore, for us at least, it was a better strategy for us to use. Also, it's a much more liquid market, so you can scale the strategies up quite a bit. The VIX futures market was, you're talking notional values that are multiples that exponentially higher than any single equity underlying. So for us, those were all the reasons we looked at this as like, hey, this is a pure play. Let's really narrow our focus. There wasn't a lot of guys doing it. This was 2014 when we really started the strategy. So we were very niche in that there wasn't a lot of people looking at doing sort of like these vol arb or long short vol strategies. So that was where we wanted to play, and I loved it.
Yeah, that's a great point. 2014 is super early. For those who are kind of new to the space, the VIX created in 2004, and I think the first VIX futures maybe were in 2007, if I remember right.
7. Yeah, they came at the time, obviously, when everybody needed them, which was around 7, 8, I think, is when they really got very popular, obviously. So, it's not surprising that those things coincide. But yeah, that's when it really took off. And, there were guys that are earlier to the game than us, of course, but it was still a relatively niche industry, and that was one of, I think, our sort of natural advantages is that we understood that earlier.
Yeah, and then we have all these ETFs or exchange traded products built on top of VIX futures. So if anyone's new to this and has never seen UVXY, look at a 5-year chart of UVXY, and you'll quickly notice that it tends to go down a lot because
Correct.
The cost of carrying vol is expensive. So when you're trading these products, is it more complicated than just buying put spreads on UVXY and then collecting over and over again?
Yeah, I think so. The easiest thesis, and this was obviously part of how we sort of launched, was like, look, the trade here is very obvious. If you look at that chart, it's built to go down. The thing that you're really trying to avoid is those temporary spikes that go up. So, our strategy was focused on identifying different volatility regimes, and honestly, buying puts or put spreads on VXX, UVXY, VIX futures, whatever, tended to be not very profitable because you end up paying too much for the vol itself, because everybody wants to buy those puts. And what tends to happen if you go sideways or whatever is you end up losing because you pay too much for the implied vol. So there's a combination. You're either selling call spreads to buy put spreads. We would identify different areas where we want to be, do things like long VXX versus short UVXY. So we'd be VXX as a 1x and UVXY was a 2x. So we would look for the implied vol differential in there and try and trade those different pairs. So the number of ways that you could trade it was infinite. The longer we spent in that industry, the ideas you could come up with just it was great as almost like a creative endeavor to come up with different ways to trade just pure vol.
Yeah, that's fascinating. So now you touched on something, the Volmageddon event of February 2018. So
yeah,
one of the things that became obvious is that the trend of VXX or UVXY is going down constantly. So some folks invented XIV, which is the inverse of VXX or UVXY, one of them. And basically that thing would just go up all the time. And then something happened, Volmageddon. Can you touch on Volmageddon and how did that affect your book and how did you trade it?
So it's super interesting. So Volmageddon, I think a lot of people, got caught in this trade where what happens with XIV and SVXY was the proxy, the ETF that was traded on it. Basically, yeah, it was built as an inverse so that you could basically go long, and you're benefiting. It's another short vol trade. So it was kind of another way to sort of stack on top of all these other trades, another way to short volatility. But in the fine print, if you read it, it says if the VIX ever goes up more than 100% in a day, basically it will crush naturally, because that means the XIV has to go down 100% in a day. It will cease to exist. And that happened. It went from 26 to 52 or something in a day. And so, and as the fine print says, goodbye. So people and this is true of every industry, if you don't read the fine print, beware. So naturally that happened. You saw the whole trade unwind. You saw the product get delisted. You saw SVXY unwind in a day or something like that. And it was really, it's interesting because there's all kind of parallels to what's happening right now. It's the same sort of thing. It's like if you don't read the fine print, you're probably gonna get run over. Because what you find out also as a vol trader is, in a way, the market is always short vol, or I should say investors are all short vol, right? If you're long, in a way, that's synthetically a way to say that you are short volatility. You're anticipating things continuing to move up and to the right. But as it turns out, things don't always do that. And suffice to say that if you're in these sort of levered products or these synthetics, there's a lot of pain that can come from these trades. And it's a lesson, I think, for anybody. We watched it happen from the outside looking in, but certainly it was something that, it was painful for anybody that was in the ball markets if you were caught off guard. And it's one of those lessons you learn along the way, which is always read the fine print, don't lever long or short, and just be aware that the things that you think can't happen, or the things that are in that sort of tail, that 5 standard deviation, it happens more often than you think. This is the anti-fragile sort of argument that, markets do things that are unexpected more often than they are statistically supposed to. So, one of the many lessons you learn along the way as a trader.
Yeah, that's fascinating. And so you made the transition into crypto vol, which is obviously an asset class that we both love. So what was the catalyst for that? And what really, what kind of stuff are you seeing in crypto vol that is the same or maybe different from equity vol or index vol?
Yeah, I think the thing that sort of lured me in, because I will say, as the sort of suit and tie TradFi guy that everybody was at some point, I had written off crypto as the the cool kids thing to do, because I watched the whole 2017 thing and 2018's subsequent rise and fall, and sort of wrote it off when it was on the rise, and then watched it fall and felt very sort of justified in my stance of staying hands off. But I did eventually, one of the guys I worked with said, you really should at least read the white paper on Bitcoin and see what it's about. So that's what got me in. I bought Bitcoin in 2018. So at least I had a toe in. I had some skin in the game. And when I was on my sabbatical, we'll call it, one of the guys that I worked with said, this is when they were launching the fund, you should look at the vol space, because it had really just started with Derivs listed options in 2019, I believe. And then this was in the middle of 2020. So I started to take a look, and I was like, wow, this vol space is huge. And this is, such an opportunity. So it was probably me looking in like like a hungry wolf. Like I was like, I can't turn this down. I have to at least try it. And it's been everything and more than I expected it to be, which is, I knew it was going to be high vol, but I don't think anything prepares you for the type of vol that crypto is. Now is a perfect example, but I came in when the vol was to the upside, and I wasn't prepared for that. And statistically, if you look back at Bitcoin or ETH, the vol has traditionally and still technically leans to the upside. The parts that people get blown out on it's the short call side, more than it is the short put side, because the thing goes up 1,000% in a pick your time frame. But the point is, it's something where you have to be cautious on both sides because, man, if I thought the SPX could move, this is like, or VIX, it's like, this just leaves that in the dust, which is, it's interesting. It makes you reconsider, the market always teaches you that if you didn't learn your lesson already, I'll show you again. And crypto has been that perfect teacher for me too, where it's sort of put your assumptions down, remember that you don't know everything, which I kind of love as a trader. It's this process of improvement. There's no end game or perfection. But I love that about crypto. It's obviously this brand new asset class. I won't get into the philosophical reasons that I love it or agree with it because I have that too. But just from a financial standpoint, it's been a completely new sort of volatility asset class that's been fun, emotional, testing. Now is certainly an example of those trying moments where you have to continually reconsider your notions of what is normal and statistically possible. But yeah, that's been my foray into it, and obviously where I am now.
Yeah, that's fascinating. And it's so true about sort of like the difference in vol structure historically. So like 2017 and just spot prices, we have this huge explosion up. And then 2018
Mm-hmm.
kind of floats down. It's a bear market, but we don't see that
Mm-hmm.
panic crashing. And then
Yeah.
2020 happens and it gets chopped in half in a day. And then 2021 is
Yeah.
a huge, massive upside and volatility rally. It's so interesting
Oh,
that,
it's
you know,
crazy.
whereas equities, it's a
Yeah.
little bit more predictable. Like we're gonna crash down and we're gonna float up type of deal. And crypto has it
Yeah.
can go
At
both
least
ways.
I think you tend not to break through the barriers of what the implied moves are, right? Like, the DOVs are a great example of this, and I don't want to jump into something but the DOVs basically collar price a lot. And I think if you do that same strategy on the SPX, you probably win whatever the whatever the delta is that you sell, right? If you're selling a 15 delta, you're probably winning 85% of the time. I would say for crypto, that tends to be true less often, and especially more recently, which is to say, vol is often or more often mispriced because the nature of the asset class is it's just less predictable, and so that makes it interesting, um, heartbreaking for some, obviously, extremely lucrative for others if you can tame or harness some of that volatility. But for me, I think it's I enjoy it as an investor, trader, manager because it's certainly not boring, and I think that this is my own journey. You look for things that are really more fulfilling ultimately, and it's not just about you don't want to do the same thing forever. So I did 6 or 7 years in the equity vol space, and I think crypto vol has a long, and it's going to be a really fun thing to watch it play out because you're seeing it through the sort of the teenage years right now where it's very unbridled and volatile, obviously. And I think that'll also get tamed, and you're going to watch this happen, right? You're going to see institutions come in over time, and they'll start to make deeper markets across multiple exchanges. And that's the nature of all things is that if there's money to be made, right, there's investors that will come in, and there's large banks that will come in and start to really create very deep and liquid markets for this. So I'm excited to sort of watch that happen. I think we're at some pretty critical levels here where you're seeing institutions, or I'll say large crypto institutions, are now being tested, which is another side of vol that was not anticipated, right? Almost that you thought that these multi-standard deviation things that couldn't happen are now happening because you had so many people that were essentially short vol lenders, obviously Three Arrows and the BlockFi's and Celsiuses of the world now. In many ways, these guys were all short vol. They were counting on this up and to the right trade to continue in perpetuity. And it turns out that if you knock a couple of these dominoes over, nobody expected that. And now you don't have any sort of backstop that you have in equities. So it's really interesting, I think, to have what is truly a free market operate with any, there's no Fed coming to save you in this world, and I think that's something TradFi guys struggle with, and I'm not excluded in that. Where you think like, oh, there's a floor here, and it's like maybe, it's like we'll find out. But the thing that you thought could be the bottom, there's no Jerome is not coming to save crypto. You know what I mean? It's like there's no Fed put here.
Yeah.
So it's interesting to see this. It's like true free market capitalism in a way that is scary, but it's like very pure. And I think that makes it really interesting, especially from a vol perspective.
Yeah, that's fascinating. Like UST, the Luna stablecoin is a great
Oh,
example. That thing just went straight to
perfect
zero,
example.
and no one here to bail it out.
No,
So
but nobody could stop it, and it's interesting because it has the inverse effect of what is too big to fail in TradFi becomes too big to succeed if you just knock a couple of legs out of the bottom. It was so heavy that nobody could. There's no backstop. You can't save 40 or 60 billion dollars worth of liquidity because nobody's going to come in and they can't prop it up, right? They're just going to go. It's what a bank run I imagine would have looked like in the 30s, because there's nobody there to say, oh, hold on, we got this, guys. Don't worry, there's money here. It's like, no, this is what happens if you don't, if things aren't right, get out. And you watch the. I think you'll see this sort of fire probably cleanse some of the crypto underbrush right now. And as painful as that might be, it's part of the process. This is how crypto sinks or swims, is you have to clear out what was over levered, under collateralized, short vol trades that these guys were playing for the up only sort of market environment, and it turns out that there's another side that can also feel quite painful.
yeah, absolutely. And I think in the long run, these types of events are so good. It's like the forest fire clears the brush type of deal. And so everything
Mm-hmm.
gets built on a more solid foundation. People finally have a chance to buy good prices and become holders if they had missed
Yeah,
the previous two bull runs. So in the long run, I think this is
yeah,
constructive. So
and that's what's truly productive in the marketplace, right? It's like, how many dexes do you need? We're going to find out. It's certainly not 30.
that's a great point. So, kind
Yeah.
of jumping into now the crypto side of things and strategies and TwoPrime. So, in the crypto world, we've had a lot of bear and bull markets, but we've also had investment cycles on different kind of types of investing. So, we had the ICO phase, then we had
Mm-hmm.
farming phase, the NFT phase, the airdrop phase. So, there's a lot of these kind of yield strategies that exist specifically in crypto that are kind of new events. Do you guys do some of those strategies, pursue some of those kind of on-chain strategies as well?
The short answer is no. And I'll say this: we did, but I think you know, I I personally always had an issue with I would ask the same question: where's the money coming from? Where's the money coming from? Where is this money actually being generated? DeFi was a great example and still is. And I understand if you lend it out for this much and but I would say, well, Anchor is a really good example. I was like, there's no way that this is sustainable, and you can see it in their treasury. They put it right on the screen. Um, and we did have a DeFi strategy that we ran for some amount of time, and to be honest, it suffered immensely when UST was liquidated. So we kind of pulled back from that and said, look, this isn't a really good thing for us to do. It's really not our strong point. Let's focus on doing what I consider one of the few sort of organic sources of yield other than maybe lending, which is volatility premium. This is something that has existed for decades in traditional finance, and something that will definitely exist in perpetuity in crypto, because volatility is an asset class and you can trade it and you can generate premiums from it. I think it's still niche to a lot of people, but the reality is, if you want to generate yield on what is currently an unproductive asset like Bitcoin, You can't stake it and earn anything on it. Volatility is a source of yield that you can generate. Pick your target, and you can do, I want to make 3% a year, or I can do 7, or I can do 20 if you want to be very risk on. But I think, for me, it's familiar. So I say these things sort of casually, but maybe for some folks that aren't really attuned to the volatility space, it might sound flippant. But the reality is you can literally find, and this is, I'll say, I use Gball all the time to do this. We go and look at the annualized yield on the calls and the puts, and we literally identify which call and which puts we want to sell, or which puts are the cheapest for me to buy right now, and I'll go buy the cheapest and sell. So we'll play the curve, and we can go, we'll look at, all right, the curve's inverted right now, we're in backwardation, we're going to sell front month, we're going to sell July 1 or July 8 falls right now to buy July 29. So, there's all these really interesting strategies that, if you're a vol trader, this probably sounds familiar, but if you're not, it's like, whoa, how do you do this? But the reality is this has existed in TradFi. Commodity traders know all about this kind of stuff. This is how you hedge positions. You do call overwrites. You collect that premium. You buy puts or spreads or ratios. So you can do so many more things in the derivative side that, for us, we focus on yield generation. Obviously, commodity guys typically use it as a hedging strategy. Miners in the Bitcoin and ETH space obviously want to use it as a hedging strategy, and they do. So I just think it's much more of it's got longevity beyond. I don't want to say DeFi doesn't have this. I believe in DeFi. I just think it had to be cleared out. But for me, the purest place to find yield is vol. And I'm sure I'm biased, and I don't, if there's folks listening to this, they're like, well, DeFi is huge. I get it. There's billions and billions of TVL locked. So yeah, I believe it's going to make it. It's getting vetted right now very hard. But yeah, that's, my sort of philosophical stances and purview is definitely vol yield. So I'm sticking to it.
Yeah, that makes a lot of sense. And so you
Yeah.
mentioned earlier in our conversation that TwoPrime has 200 million under management. How big is the investment team? And also, do you guys run, like some hedge funds have multiple kind of sub funds? Do you guys have sub funds, or is it one sort of core fund? How does that work?
Yeah, so the breakdown is really that the structured product that we have, which is called the Digital Asset Fund, is probably about a quarter of the total AUM. And then we have a number of separately managed accounts that we run similar strategies on with different yield targets. So I kind of mentioned this in passing, but we can basically create bespoke strategies where, certain investors, these crypto natives that have had Bitcoin in their wallets for whatever, 7-10 years or something, they're much more attuned or accustomed to the amount of vol in the market. They want to hit a 15% APY. So we can go, all right, we can do that. We'll look at the different call structures or spreads or puts or whatever that we need to buy and sell to do that. And that's what we'll target. For some of the larger institutions, miners that want lower vol strategies, we can literally just size positions down and say, look, we can target 5% APY. And we do that for different SMAs. So we've got our digital asset fund, which is a combination of basically hedging on the downside with yield and volatility premium that we collect over time. And then for these SMAs, we create for larger, sort of sub accounts, we'll do bespoke yield strategies that target whatever the APY is that these clients want.
That's great. And if someone wants to learn more or get in touch with you guys, what's the best way to do that?
Yeah, our website obviously is a great place to start. It's twoprime.io. You can find us on Twitter. I'm sure we can leave or link or all those things there. I'm on Twitter. We'll throw my handle in there. It's at Nathaniel J. Cox. So yeah, we've got Twitter and our website, and hopefully we can link these things in the show notes.
Absolutely. Great. Well, then, just a couple last questions here before we wrap up. So one question that I think is really good for newer traders are, what is a good book, if you have any, that you recommend to someone getting new to the vol space that really helped you along the way?
Oof. I will say some of the introductory things that really helped me. It's not a book, but it's a website. Tasty Trade was a great resource for me. I don't know if you're familiar with Tom Sosnoff, but he was the builder and sort of creator of Thinkorswim, and then broke away and did his own platform on Tasty Trade. They have, I mean, they're just great content about derivatives trading. These guys are deep in the options trading world, so I think that's a great place to start. I like anything by Jem Carson. If guys that want to look there, RCM Alternatives. I love their podcast. So if folks want to look there for some more sort of advanced content. But then books by Nassim Taleb. I think it's Thinking Fast and Slow, or I might be missing my books and authors. But those books, I think that they're not so much about derivatives trading, but really about how to think about the way that markets move and also surprise people. That was some of the just sort of logic that really helped me conceptualize where risk is in the market.
Yeah, that makes a lot of sense. Yeah, the Thinkorswim, I'm a big fan of that platform. I've always used it, and it's so good.
Awesome.
Yeah.
And beautifully built platform for options traders. I can't tell you. I'm just waiting for that thing to be built in the crypto world. So
love it.
I'm really hoping, I'm pulling for that.
And then kind of last question is, you're running a hedge fund. Obviously, that's pretty much a 24/7 job. How do you find balance, or do you find balance, or what do you do for fun?
Yeah, for me, everything that I could do outside and do anything that involves some sort of like exercise, hiking. I'm getting into road biking right now. So in Holland, as people probably know, Holland is big on biking. So I just did a 40-kilometer ride today. I'm slowly building up my endurance. So I'm trying to get in. It's very zen. So when you're there, you're completely present and you can't think about anything else, which is great if you're a trader, because it's nice to just focus on something else and not think about the market for, an hour and a half or 2 hours.
That is awesome. Well, very cool.
Yeah.
Well, everyone, thank you for listening in. Nate, thanks so much for coming on G-Vol Podcast. And remember, find edge, capture alpha, and slang size. Thanks, everyone.
Thanks so much.